Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So you can head over to youtube.com and search Bloomberg Podcast. As Amy was just reporting, Apple moving higher. It's now an intraday all-time record. Good for them. It's taken the lead over NVIDIA as the second most valuable company in the world, while also reclaiming the $3 trillion market cap valuation. So big day for Apple's stock shareholders. Good news for them. Let's break it down a little bit here. Angelo Zino joins us, Vice President and Senior Equity Analyst at CFRA Research, joining us from Nueva York via Zoom. Angelo, thanks so much for joining us here. How did you interpret yesterday's news from Apple? How big of a deal or not was their announcements?
Yeah, I mean, thanks for having me, guys. So, as far as, how big of a deal it is, we think it's a big deal. To us, the Siri probably just got its biggest upgrade ever since its, original kind of appearance back in 2011. And you kind of look at what they've done across the ecosystem, the new AI capabilities and tools that they're going to push out to developers now. There's going to be a lot that they can do with these tools, and in terms of upgrading their apps and providing new capabilities out there to the consumer. May not necessarily be something you see over the next kind of 3 to 6 months. May take some time here. That's why we've told investors out there this is going to be more evolutionary than it is some sort of super cycle that you're going to see later this year. But that said, I mean, I think what's really important here is you kind of look at most consumers out there today. Most consumers aren't using kind of AI in the sense of ChatGPT, among other type of large language models out there, to the extent that they possibly can. And when you kind of think about what Apple is doing, is they're throwing that kind of ability out there for consumers to have it directly in their hands. And we think that's a big deal. And we think that's going to cause consumers out there to ultimately upgrade. It may not be the 16, it might be the 17, but ultimately it's a very positive thing for the evolution of Apple.
You maintained a buy rating on the stock after yesterday's news following the conference, but then also if you look at the A&R function, I know Paul likes to look at this in the terminal, there's 40 buys, 15 holds, 5 sells, and Paul and I were just chatting about how this stock, when you're looking at Apple, up more than 20% since that April 19th low. How much more room do you think the shares have to run now?
Yeah, so Jess, I think that's a great point. So you kind of look at the move that they had going into the announcement here, right? I mean, it's a fantastic move. The stock was actually down, I think, about 14% on a year-to-date basis into late April, right? And I think that kind of the story from January to April was, hey, listen, we've got some China issues, expectations in the second half of this year may not be able to be met. Now you kind of change the narrative around since kind of their earnings release in early May, as well as kind of this developers conference here, to one whereas, hey, those numbers may not be attainable, to, we've got now 6% expected growth for the iPhone 16 cycle. There's probably upside to that number instead of downside. So in our view, the narrative has changed. It's all about whether or not, or how much upside can we see from that iPhone 16 cycle at this point in time. We think there's upside to the 6% number, probably at least 8 to 10%. It'll all be dependent also on whether or not Apple can Apple looks to increase prices in the next cycle. That remains to be seen. But in our view, there's upside potential that still remains, despite the move that we've seen here over the last 5 to 6 weeks.
So, Angelo, I'm out there in the marketplace sporting an Apple iPhone 11. So I'm guessing I'm ripe for an upgrade.
Oh, an 11.
Yeah, I guess
I have a 14.
I guess I'm ready
and
for the upgrade.
Mine's a few years old,
I
so
know,
yours
I
is
know.
extra.
It's ridiculous. So, Angelo, do you think there could be people like me that are going to take this AI features that'll be coming out in the iPhone 16, I guess, in mid-September? Are there going to be people like me that are going to go out and upgrade? Is this going to be a real driver of unit sales, do you think?
Yeah, I mean, listen, I think, first off, there's not much of a bar to beat here because the iPhone 15 cycle is a down cycle. If you actually look at the 14 cycle, it was a relatively flat cycle as well. So we've kind of had this kind of pause here over the last kind of 2 cycles in terms of on a unit basis, right? Whereas the 12 and 13 really took a lot of kind of upside there because of some of the China market share gains because of the 5G cycle, upgrade cycle, and what have you. So as we kind of now look here into the 16 cycle, I think a number of things here. As far as kind of the fact that the iPhone 12 was that last big upcycle, you're now looking at 4 years past that. So a lot of the 12 consumers out there are going to potentially look to upgrade. But for someone like you or even someone like myself that haven't upgraded in years, forget about the AI capabilities, just the camera capabilities that we've seen since the iPhone 11, you're going to see some notable enhancements. But I do think kind of the new AI capabilities out there will drive some of those older consumers to upgrade. I think also, listen, these AI capabilities don't work on anything kind of outside of the 15 Pro devices kind of. So you can even potentially see some iPhone 13 users or 14 users out there look to upgrade as well.
Talk to us more about when we're saying AI capabilities, what exactly are we going to be able to use on those devices that's going to be different from before?
Yeah, I mean, listen, I think most of it is pretty basic in nature versus kind of what we've seen thus far in some of the announcements we've seen, right, in terms of what Samsung has announced at the S24, what we've seen Alphabet with the Google Pixel and what have you. But clearly Siri getting its upgrade is the big thing out there. Embedding ChatGPT functionality in there as well is a big deal. But they showcase capabilities like rewrite, summarization. Genmoji might be a cool thing with some of the younger users out there. They showed some cool stuff on the photo side of things. So there are going to be incremental additions in terms of AI across their ecosystem that you're going to be able to kind of use and just ultimately kind of make yourself just more efficient in nature. I mean, if there was something in an email that you had forgotten to put in your calendar, that's something that kind of Siri is going to be able to help you with, whereas you no longer have to kind of go back and search that in your email box. So a lot of kind of small, useful information. We'll see how well this works once it actually comes out and it's actually in the hands of consumers out there. But that said, I think a lot of it is incremental, but I think the way Apple kind of markets their iPhone devices and all their devices in general, when you kind of throw the AI storyline on top of that, I think that's really what kind of is going to capture the appeal of a lot of those consumers out there.
All right, Angelo, thank you so much for joining us. Angelo Zino, he's a vice president and senior equity analyst at CFRA Research. I actually think I will go out and get a new iPhone with the new one in September.
Look at you.
Mm-hmm. And I'm not for AI, not for the camera. I don't know.
I kind of need a new camera.
I don't know if
mine's a little too fuzzy and grainy. However, I have dropped my phone many times, so that's not Apple's fault. It's actually my own fault.
Well, my thing is it's all about the battery. When the battery starts dying,
that's
my clue to upgrade. And it has been kind of losing its...
Right. I keep having to charge mine multiple times during the day.
So I think that's kind of the way. That's historically been my...
So you know what? Maybe you and I both will have new phones later.
Yeah, we'll walk over. I mean, the good news is we have a huge Apple store just, right down the block here.
That's right.
On Fifth Avenue.
It's across from the plaza.
Across from the plaza. I walk past it, the Penn Station every day. Sometimes I'll just go in there with the other throngs of billions.
Yes.
Tourists go to that store.
Oh, it's always packed. It's
always
wild.
Packed. Crazy. So maybe I'll go there. And that's where Tim Cook comes. When he comes into the city, he does some of his product launches there at that big Apple store.
Look, that stock trading above $202 right now, still trading at an intraday record. So eclipsing those December all-time highs, Paul.
Good news for our friends in Cupertino.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tomorrow, again, all eyes turn to the Federal Reserve, as it tends to do from time to time. We have the statement coming out at 2 p.m., press conference at 2:30. Michael McKee, Bloomberg's own Michael McKee, probably hopping on the Acela later this afternoon, heading down to D.C. so he can badger Fed Chairman Jay Powell.
That's right.
In our studio
today.
today.
This is so exciting.
This
the
is
suspenders
unbelievable, people.
with the soccer.
He must have found
here.
the New Jersey Transit train station, which he lost, forgot about for a long time. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. In studio with the soccer ball suspenders, which Jess loves.
It's great.
Ira, I guess tomorrow our expectations should be low for market-moving news coming from the Fed. Is that how we should approach it?
Well, not necessarily. There's the possibility that the Fed will shift its dots, not only for this year, but more importantly, at least from my perspective, will be the 2025 and 2026 dots.
Okay.
So if the Fed were to move those up because they think that maybe the economy is going to be a little bit more robust, they won't have to cut interest rates quite as aggressively as the prior dot plot from the March meeting, then the back end of the yield curve in Treasuries could potentially move quite a bit. We don't see liquidity isn't great right now in the Treasury market, so you can easily have a 10 or 15 basis point.
Liquidity great? It's the biggest market of anything in the world.
Well, but that's the reason, right? We've been issuing a whole lot of debt,
okay.
and there's only a limited number of buyers. So just because you have a lot of debt doesn't necessarily mean that there's going to be an equal number of buyers out there. So it's not that the market's not owned, right? So the Treasury Department issues bonds almost every week now,
yep.
but basically all the time, and those get purchased. Now the question is, in the secondary market, how easy it is to sell those bonds into the market, and is there a natural buyer on the other side? And the answer is sometimes yes, but occasionally, in order to find those buyers, the price has to move quite significantly to entice people into the market.
What do you think bond investors want to hear from Fed Chair Powell versus what you think we actually will hear in his commentary?
Well, bond investor, if you're long, you want to hear them say that, hey, we're going to cut interest rates, starting in July, and that's certainly what the longs would like to see, right?
Yeah.
We're not going to hear anything like that. In fact, we might just hear the opposite, and I think that's one of the reasons why the people in the Treasury market have been pretty cautious. Positioning is now much cleaner. You had a lot of people who were short. They kind of exited those positions when we were actually near current levels, or even with yields maybe 10 or 15 basis points higher. But the sell-off they think is constrained because it does seem like the Fed believes and is trying to convince everyone that at some point we're going to cut interest rates. So it's going to be hard for sell-offs to be maintained for a very long period of time. Particularly now, going back to that supply story, the Treasury Department is not issuing more debt than it had been before. The issuance pace is basically constant, whereas you go back 9 months ago, they were continuing to increase the amount of debt that they were issuing, and that's actually slowed down quite a lot.
What does a government bond trader do today before a Fed meeting? Do they make sure they're flat, they're fully hedged? Do they play their gut and go long or short here a little bit? What do they typically do?
Yeah, that's a good question. So I've talked to some folks on the sell side in the last couple of days, and a lot of them are just confused. So they are relatively short, or relatively flat, I should say. That being said, if you look at the positioning data, so the Federal Reserve every single week actually polls the dealers and gets the primary dealer positioning data. Now,
are they honest when they're responding to that?
Well, they have to be.
They have to be. Okay.
Yeah. I mean, because if they're audited, when they're audited annually by the Fed, if they don't do their job, they're get in trouble. But dealers in aggregate are as long treasuries as they've ever been. It's almost record longs in terms of the notional amount outstanding. So dealers are long, but on the other side, they're also not quite record short, but they're hedged a lot with futures. So it's like they're long the cash and they're short the futures. So they're in what we call a basis trade, where they're playing some relative value, not taking a ton of risk, but they still have a lot of cash cash securities that they have on their books.
I track a lot of the big banks and obviously their outlooks for when the potential of the first rate cut could happen. So Goldman Sachs, for instance, over the weekend, they still reiterated that they were thinking it was going to happen in September, but then they thought a second cut would happen in December rather than November. When you're looking at the bond market, what is that really telling us as far as what the consensus on the potential timing is, but because it is an interesting dynamic because you have September and then November. Actually, that interest rate decision is the same week as the election, so the meeting starts that Wednesday, not that Tuesday.
Yeah, they actually moved the meeting to avoid the election. So the meeting now, the release will be on Thursday. Okay, be the first time we've had a Thursday release that I can remember, and I've
quite
been doing
some
this
time,
for 20 years.
So not a lot of people have been looking that far ahead to the calendar, but I have it circled on my desk. So I wanted to ask you your thought process about the timing there.
So I actually suspect at this point the Fed, unless the CPI data really comes down massively and we start to have job losses in the next 2 months, which doesn't seem likely, I doubt that the Fed's going to do anything prior to the election. So I think September, while it's not a 0% probability, I almost never say that, but although tomorrow's a zero. Well, I think that it's very possible that if the Fed starts to cut rates, it'll be in November or December. And there's a growing possibility in my mind that the Fed might not start cutting rates at all this year, right? It might not cut rates until 2025 because the economy, even though it's slowing, is still reasonably robust. And when you look at a lot of the preponderance of the data that we look at, particularly the hard data like retail sales and even the job market, although Anna Wong and our colleagues at Bloomberg Economics certainly see some cracks there as well.
What is it about September in particular why you're seeing kind of more firms expecting it that month in particular versus others?
Because they're just moving it from July.
Right, as you keep pushing it out.
Right? Yeah, they're just pushing it out. I think that the Fed will still avoid September, even though they'll always say that we'll do what we have to do regardless of the election. This would actually be the second closest to an election that they've made an initial move if they were to move in September. They basically would say to themselves, they'll never say this publicly, but hey, why don't we just wait 6 weeks? Realistically, we don't have a lot of data, and if the data is not absolutely crashing, there's not a fundamental need for us to cut this moment. We could just cut a little bit faster later.
Once they do start cutting, what happens then? Do they cut every month, every other month, like 25 basis points, 50 basis points? Does the 5.5% discount rate go to where? I don't know.
Yeah, well, it would depend on the economic situation, but at the end of the day, I think they would like to cut in 25s. And certainly that's one big reason to look at the 2025 and 2026 dots, because that'll give you a hint as to the pace, right? So at this point, it looks like every other-ish meeting is what they're thinking that they'll cut.
What's a big soccer story out there in the world today?
Oh, well, Real Central New Jersey has a home match tomorrow, so we have our beer garden getting ready. And
where does Real Central New Jersey play the matches?
We play at Rider University.
Yep.
So right
in Lawrenceville, New Jersey.
Yep, which is right in between Princeton and Trenton. So we get we've gotten pretty good crowds. We actually have record attendance this year, so pretty excited about that.
And who do you play?
Tomorrow we play Lehigh Valley United Rush, which is
and where do you get your players?
Almost all of our players are Division I collegiate athletes.
Does Paul, do you want to join in?
No, God, no. I might join in on the beer bash.
I've been joked around about that, and I'm like, I don't want to pull a hamstring like the first 15 seconds I'm on the pitch. Right?
Anything on the professional level that we should pay attention to?
Well, one of our local teams here in New York is doing really well in Major League Soccer. So New York Red Bulls is doing great. They got a player named Emil Forsberg from RB Leipzig, and he's been tearing things up along with some homegrowns. And
they had a great stadium, the Red Bulls, over there in Jersey. All right, Ira Jersey, thanks so much for joining us. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence, joining us here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Surprising news in the financial markets, and I learned something. You need to look at the gap between the 10-year French yields and their German counterparts to see kind of where the relative risk is in the marketplace. And the gap between the 10-year French yields and their German counterparts climbed to the highest this year in the wake of Macron's snap election. I'm not really sure why, but we have somebody who does
who can talk to us about this and walk us through.
Marcus Ashworth, he covers all that European stuff with an acerbic wit, and I mean that in the nicest way. But we love talking to Marcus because he spares no bones here. Marcus, what was your reaction to what we saw out of the European Union and then the subsequent decision by Mr. Macron?
Hi guys. I was thinking that this was a long time coming, but it was worse than perhaps everyone, including Macron, had expected. And therefore it put him in a very difficult situation with, I guess, his main opposition polling more than twice, which his party got. They only got like 15% or something. So though he has another 3 years as president if he wants to, I don't think he'll resign, but there was some question about that today. He means he won't have the ability to equivalent of Congress to be able to do very much. He can still do a lot of presidential decrees, but nonetheless, it's boxed him in. And more importantly, he can't run again. By then, by 2027, his 10-year legacy would be pretty poor. So I think what he's deciding to do now is gamble on a political swing, which has gone to the right wing, that perhaps the French people, if they're challenged again, may push back against that. But the consequence of this is that the bond market in particular, and the stock market, and to some degree the economy, is going to have to take a little bit of a, how can we say this, a bit of a shake-up, because politically this is a very aggressive move, and it also puts into very much sharp contrast the financial fiscal situation of France, which is rising ever inexorably higher in debt, and particularly its budget deficits. Annual spend is much more than it takes in. It's 5.5% last year, which is pretty shocking, and not likely to drop much by next year. And I think the European Union could put it into sort of double secret probation. They call it an emergency deficit procedure. But really what it means is that in the sin bin, and that's hugely embarrassing for Macron or any government. But the point is the rating agency, the credit rating agencies, we saw S&P at the end of May knock France down to a AA-. Fitch are already there. And Moody's today came out and basically said they're one notch up at AA2, but they may be having a look at it. So it's all about a worsening credit of France, a worsening political regime, which makes the European Union very nervous. Because, we've seen with the previous situations with Greece and with Italy, they'll turn a blind eye to most things, but they want everyone to be very much pro-Euro. And Marine Le Pen's right-wing party, which is the National Rally, though they no longer argue for Frexit or France exit, they once did. And memories are pretty long in Brussels. So the last thing they want is a non-fully backing Euro-style prime minister, even under Macron as president. That'll be very unsettling for Brussels. That means it's very unsettling for credit rating agencies. Panic, panic, panic. It means that French debt is perhaps a little bit more risky, still pretty safe, but a little bit more risky than it was before the weekend.
You were talking about how France has seen a sustained deterioration in its fiscal position, particularly when you're looking at its debt load. How did France get into this position?
They spend more than they earn, or more than they tax. The reason is, Macron was elected on reforming the fiscal situation, and principally one of his key things was raising the retirement age, which he raised from sort of really 60, 62 up to about 64. He wanted to get it up to about 67, which, for instance, is where the UK is, but massive pushback. And the fact he very basically couldn't get it through unless he pushed it through by this, as I mentioned before, presidential decree, worried some of the rating agencies then. Now the fact that he has gotten really no way of getting stuff through the National Assembly, their parliament or Congress, is a really scary situation. So, that means there's even less chance of any form of fiscal improvement, of getting that budget deficit down and reducing the overall indebtedness of France. And that's a pretty difficult situation, complete gridlock, because if the National Rally were to become the party to have the prime minister and try and form some form of cohabitation, I think it's in English, is that they won't get any, they won't allow any form of spending cuts or anything to reduce the benefits that a lot of French people. 58% of the French economy is state spending. It's a very socialist driven state, and they don't like their benefits getting touched, which means nothing will happen at least 2027. No improvement on the fiscal outlook. That's very bad news for bondholders, for credit rating agencies, and indeed probably for European Union cohesion.
So I note in your column, Marcus, perhaps one of the rationales for Macron's boldness here is that it will actually force Marine Le Pen to maybe reveal what her plans for the economy are. What do we know, or what don't we know?
Well, they deliberately, a bit like the Labour Party is about to take power in the UK, they've been very, should we say, recherché in telling us what they are actually planning to do. And Marine Le Pen has basically said no to many things, but hasn't told anyone really what they're planning to do, how she would sort the pension situation out. But the one thing we know for sure, they are pretty anti-immigration, and they are pretty anti the pension changes and any other form of benefit changes. So it's going to be almost impossible for the government to stop its welfare spending bill, and that can only mean essentially this would be a deficit and debt to GDP ratio negative scenario. I would think it'd be very hard for her. But Macron's gamble is precisely as you laid out: is that if they put them in power, at least nominally, the prime minister doesn't have anything like as much control as you would think, but they have ability to try and put some things through. If they turn out to be incompetent and they turn out not to do what they said they were going to do or anything like this, it would make the presidential elections in 2027 a little bit more anti the National Rally and pro, should we say, Macron's or more centrist. The huge gambles, it could go the other way. These guys could turn out to be very good in power. In fact, the centre-right are already talking about maybe teaming up with the National Rally, the far right, and creating an anti-Macron coalition. That could become very popular, and we could see it would be a very stupid gamble that Macron's taken. We just don't know. The point is, if you're a bondholder, and indeed, as you've seen with the French banks like SocGen got hit really hard yesterday, why would you want to take the risk and perhaps go to somewhere a little bit more safe like Germany or, I don't know, somewhere else in Europe?
So, Marcus, you were just bringing up SocGen. What other parts, when you're looking at French equities, have been hit hardest? Which other ones have been maybe more shielded right now?
Well, yeah, the banks got hit hardest. They always tend to. Partly that's because a lot of international investors, particularly American investors, they're invested in Europe. They tend to like the banking sector more. There's more bang for the buck. They understand and can play that game much more cleanly. So, you should be really worrying if you start seeing things like insurance companies going, because that's a credit issue. But banks are an easy sell, highly liquid. I would expect if things do calm down and by July 7th, we know the election results, and they aren't perhaps as bad as people expected, I would think the banks would probably therefore do the best. But, industrial sector in all of Europe is in a pretty tough time at the moment. France is, world leader in luxury goods, so LVMH. Things like that. These are companies to keep a close eye on, but they are perhaps less suspect to these politics, but still not great for anyone.
All right, very good. Marcus Ashworth, thank you so much. We appreciate it. Folks, Marcus is a columnist covering European markets for Bloomberg Opinion. Check out his column today. Macron plays fast and loose with investor faith. So very interesting there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We are broadcasting live from the Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Well, despite the U.S. labor market remaining tight, a new survey reveals that the recruitment and retainment challenges facing businesses have eased a little bit. So let's break that down with Robin Erickson, Vice President in Human Capital for the Conference Board, joining us via Zoom from Chicago. So, Robin, talk to us about the labor market out there from the employer's perspective. How tough is it to attract and retain talent these days?
Thanks so much for having me today. We did find that the challenges of recruiting and retaining employees have eased significantly. As you can imagine, during the Great Resignation of 21 and 2022, it was very difficult to recruit and retain workers. But we did find that while finding talent is a challenge for more than 55% of respondents, this number has decreased from a high of 83% in 2022. And then retaining workers is less challenging because we found that only 41% of human capital leaders reported difficulty retaining workers compared to a high of 66% in 2022. So those are big changes.
Break down what specific industries and job positions are most vulnerable right now when you're trying to find qualified workers, but they're not there to match that up.
Yes. So we did look at the workforce in two categories. We looked at the workforce of mostly professional and office workers. We had about 60% of our respondents from that industry or those industries. And we also then looked at mostly those organizations that had mostly industry and manual service workers. And it's definitely more difficult to recruit and retain talent in those organizations with mostly industry and manual service workers. If you think about the difficulties that the hospitality industry is having, especially with hotels and restaurants, you also have issues trying to find truck drivers remains the most difficult job to recruit for.
So, Robin, I guess one of the big issues that everybody's trying to continue to come to grips with is, where are people working? Is it back in the office 5 days a week? Is it hybrid? Is it work from home? How is this kind of shaking out, several years past the pandemic?
So obviously with the spike in remote work, obviously there was a big spike in remote work during the pandemic. And so we actually started with our Reimagined Workplace study looking at how many employees or workers were remote, how many were hybrid, and how many were fully on site. Interestingly, the rate of hybrid workers has remained very similar. So what do I mean by that? It's in our survey, we found that 56% of the workers in the organizations that we surveyed are either hybrid and remote. So they're either working part-time in the office and part-time at home, or they're full-time at home. That's 56%. That's down from 61%, which is a difference of only 5%. And the number of workers who are fully on-site has only risen by 5% since 2022, from 39% to 44%. And we've also done some other studies here at the Conference Board and have found that flexibility is the number one request of employees after a competitive salary.
Do you find that employers are getting more strict to try to get employees back into the office? It was interesting hearing some of the stats you were just mentioning, because some of that seemed to be like potentially, but it still seemed like there still was a good amount of people working from home for various reasons, obviously.
Yes. So in the conference, the Conference Board has a flagship survey. And in 2024, we found that only about 4% of CEOs were concerned about mandating return to the office. So they were much more concerned about making hybrid work for their organizations. Obviously, there are some well-known organizations that have come out mandating returning to the office. But one of the other interesting things that we found in our study was that those organizations that allowed their employees to choose where they worked had 3 times less difficulty retaining workers. So those organizations that mandated their workers to go into the office, 45% of our respondents said it was difficult to retain workers, while only 15% of those organizations that had employee choice about whether or not they went into the office said it was difficult to retain workers. So clearly there is a business case for hybrid and more flexibility and more employee choice where it's possible.
How about AI? A lot of folks are talking about AI in so many different parts of this economy and what it means for not just the economy, but for society as well. One of the concerns is, what will AI do to kind of the workforce? Will we need fewer workers in different jobs? I know that was a big issue, for example, for the writers' strike in Hollywood. They wanted language in their contracts that protected them from AI, writers and actors. Talk to us about how employers think about AI.
So we know that the majority of organizations are interested in AI in some fashion. They've either adopted it already in their organizations or they're planning to adopt it. AI is here to stay, and organizations can actually be more productive and more efficient with AI. To answer your question, Paul, around whether or not we would need fewer employees, I don't know that we will need fewer employees, but I definitely think that employees will need to have different skills. So one of the things in our survey that we found was that the majority of surveyed human capital leaders said that they were experimenting with AI pilots and not focusing on long-term strategies like the job displacement that might come from AI, but the reskilling for roles that are different.
Very good. Robin, thank you so much. Really appreciate getting your thoughts there. Robin Erickson, she's a vice president for human capital at the Conference Board, joining us from Chicago here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.